Hello, learners. Welcome to today's class. And I want to welcome you to this platform, SANG, Studying at Network Group. It's a group that allows learners and facilitators from around the world to meet and exchange ideas on different topics. So you are welcome once again. My name is Mr. Adesanmi. I'm the facilitator on this platform for economics. And I'll be taking you through indirect tax. In our last class, I explained what direct tax is. So, and I promised to do the part 2 of the video, and which will concentrate more on the topic indirect tax. So let's go on. So what is indirect tax? Remember in the last video, I said tax is a compulsory levy. Tax is a compulsory levy that every citizen of a country must pay. So far you are an adult and you are working, it is your civic responsibility to pay tax. Now, a quick revision. I told you that there are two types of tax. We have the direct tax and the indirect tax. The direct tax is the tax paid by an individual. Now, the burden of this tax can't be transferred to another person. I gave examples of such tax as your personal income tax, your property tax, and I believe I gave you about 6 to 7 types of tax under the direct tax. So today we'll be looking at indirect tax. So this is a type of tax that is imposed on goods and services. Take note of that. It is a tax that is imposed on goods and services. The reason why it is indirect is that the burden of this tax can easily be transferred to another person. The burden of the tax can easily be shifted to another person. So, meaning the producer can easily transfer the burden of this tax to the final consumers. So, meaning the final consumers are at the receiving end, carrying the brunt or the burden of this tax in form of high price. Now, the shifting of this burden depends on the commodity elasticity of demand. The shifting of this burden depends on how elastic the demand of that commodity is. So, and in the last class, I mentioned the types of price elasticity we have. We have the elastic, inelastic, perfectly elastic, perfectly inelastic, and unitary. So, depending on the commodity in question, will determine if the burden of the tax will be shifted totally on the consumers, or the burden of the tax will be shared between the producer and the consumer. So quickly, let me show you this picture showing the differences between the direct tax and the indirect tax. So take note, under direct tax, we have the ultimate burden of taxpayer rests on the customer or the person paying the tax. Now, the ultimate burden of tax payment rests on that individual. It rests on that individual. He is responsible for paying the tax. While under indirect, the burden of the tax payment rests on the purchaser. The burden of the tax payment rests on the purchaser. The responsibility to pay that tax rests on the shopkeeper. Now, I said depending on how elastic the product is. Remember, I mentioned that. So, that will determine in a long way who will pay the tax more at the end. But the initial resting place of your indirect tax is on the shopkeeper. The initial resting place of the direct tax is on the initial shopkeeper or the seller of the product. Now, the seller of the product, depending on the elasticity of the commodity, cannot transfer the burden wholly or partly to the final consumer. Now, giving examples of your direct tax, we have the income tax. And giving examples of your indirect tax, we have the VAT, that is value added tax. Value added tax. Now, you can see the meaning of each of these on your screen. Now, the diagram you're about to see is the indirect tax in New Zealand. So these are different indirect tax in New Zealand, from environmental tax to service tax to expenditures tax to air passenger duty to value added tax to excise tax and consumption tax. We also have insurance premium tax. All these are taxes collected in New Zealand. But for the purpose of this class, we'll be concentrating more on these taxes you can see. So we have the value added tax, the sales tax, service tax, excise duty, and custom duty tax. All these are taxes that are under indirect tax. So let's take the first one, which is the import duty, or we classify as custom duty. This is a type of indirect tax levied on imported goods and services. So if a country is importing goods and services, you pay tax on those goods you are importing. As we all know that Nigeria is a developing nation, or a nation called underdeveloped, or the third world country. Now, this country, Nigeria, depends solely on importation of items. We import a lot of things into this country. And now, those items that are imported into this country, tax must be paid on them. And that is why the Nigerian Port Authority generate a lot of money from this tax, generate a lot, trillions of naira from import duties into the Nigeria account. So now, to know more about import duty, let's give this example. As you can see, now import duty, a tax that is levied on an imported goods or services. On an imported goods and services. So depending now on the relationship between or among nations of the world will determine what percentage of import duties they pay if their goods is being imported into another country. So example there, we have the EU and South Africa. They have a deal that when bicycle is imported from South Africa into European Union, they are not to pay any import duty at all. So you can see in the diagram there is zero import duty, meaning bicycle can freely move from South Africa to any European nation for free. But the same relationship is not permitted in a relationship between China and EU. So, and take note of that, South Africa bikes have no import duty. That is in between the European Union and South Africa. But if China has to import the same bicycle to any of the European nation, they are to pay 14% duty on such bicycles that will be imported into any European nation. Now, the name of this import duty or tax is called tariff. It's called tariff. As you can see on your screen, tariff. So tariff is a compulsory tax or a compulsory levy imposed on all goods and services imported into a country. I'll say that again. Tariff is a tax imposed on all imported goods and services coming into a country. So tariff is one of the measures put in place to curb excess importation of some goods into a country, depending on the policy of the country, actually. If the country is to protect infant industry in their own country against the multinationals, then they can increase tariffs on such commodities to discourage the importation of such items. So it's one of the ways that developing nations of the world try to raise money to fund their government expenditures. So the next is export duties, as the name implies, export duties. So this is also a type of indirect tax levied on exportation on goods and services, or goods and services sent out of a country. So if you are sending goods out of a country, you are exporting goods out of the country, you pay duty on it, you pay tax on it. But the tax you pay on it now depends on the value of the product you are exporting, the weight and other dimension. But it is always low compared to your import duty, because it is believed that a country should export more and import less. Export more. So if you export more money is coming into the economy. But if you import more, then you'll be losing money. So it is always encouraging for countries of the world to export more. Now, not just exporting, but exporting goods with high standard, exporting goods that are highly competitive in the international world. This will go a long way in bringing funds into the country. So the next we'll be looking at is a tax that is very common, and is a tax that is common locally. It is called excise duty. It is a tax levied on locally produced goods. So any goods produced locally must pay this excise duty. Now, it is a tax charged on alcoholic drink, gasolines, gambling, and tobacco products. So government use this tax to discourage the consumption of some of these products, especially products that are harmful to the health of the citizens of the country. So government can impose excise duty. And now, the elasticity of this product is inelastic in nature. And in some cases, is perfectly inelastic. In some cases, is perfectly inelastic. So, inelastic or perfectly inelastic, the burden of this tax can be completely transferred to the consumer in showing in high price, or a large portion of it can be transferred to the consumers. So to raise tax on them is to raise their prices and reduce the amount they are used. And that is why in some countries they call them sin tax. Sin tax. So these are taxes imposed on goods and services produced locally, especially to discourage the consumption of items that are harmful to the health of the citizens. And that is why in Nigeria, government tax the tobacco companies and the alcoholic companies well, in order to discourage the consumption of such items. And you see people still buying this product even when the price is high. Why? Because the elasticity of the commodity in question is inelastic, and in some cases perfectly inelastic. So, and that is why it is called sin tax. Sin tax. Now, the diagram you're about to see is a receipt showing the excise tax there on medical equipment, but it is low. Now, in some countries, they discourage that, especially in now where we have a coronavirus. So I believe a lot of countries who have either remove tax excise duty on the sector that produce equipment used by doctors, meaning the medical sector. Now the government will have reduced or remove such tax on them. So now you can also see bottles of alcoholic drinks. Yes, government tax them more in order to discourage the consumption of such item. Another one you will see is a diagram showing your cigarettes and alcoholic drink. So the tax on the excise duty tax on this is always very high. That's one of the ways government raise money. So they bill them more. And what this company do is to just transfer the burden of such uh, tax to the final consumers, because the product in question is inelastic and in some cases is perfectly inelastic. So that will take us to another types of indirect tax, which is the value added tax. So it is a consumption tax levied on businesses at every stage of production and distribution. So it is tax levied on the value added to the raw materials or other inputs. So remember that there are stages of production. So a good example is if I go to the nearby farm to buy corn, which is transferred into flour. Now, this flour can be used to make bread. So at each stage of adding value to the raw material, those stages will be taxed. Now, in Nigeria, initially the value-added tax rate was just 5%, but of recent it has been increased to 7.5%. In some other countries, that tax rate is very high. Is very high. So take note of this. That value-added tax is a tax imposed on consumption of goods. So it's a tax that is imposed on every stage of production. So far, value is added to the raw materials or to the semi-finished goods. So for every input that is used to add value to an output, then the government impose what we call VAT on such input. So this is a good example of a receipt that shows VAT receipt summary. So, and you notice even in Nigeria here, where you buy research cards and other items, when you go to ShopRite and other outlets, whenever you buy an item, they give you a receipt, and on the receipt you will see VAT payment. So for every consumable goods you buy in Nigeria, even down to fuel, you pay VAT on them. So that will take us to the next tax, which is the sales tax. It is a tax levied on the sales of a commodity. A tax levied on the sales of a commodity. It is collected either at the wholesale stage or retail stage. So government collect this tax from either the wholesaler or the retailer. And these middlemen just transfer the burden of this tax to the consumer in form of high price. So the initial resting place of the tax rests on them. So they pay on behalf of the consumers to the government. Now, after they've done that, they transfer the burden of the tax to the final consumer. Now, their ability to transfer the burden of the tax to the final consumer depends on the elasticity of the commodity in question, which I'll be mentioning very soon. So in Nigeria, it is paid on the sales of commodities such as petroleum commodities and agriculture export product. So this product in Nigeria pays sales tax. So this is a receipt that shows sales tax. These are examples of receipt that shows sales tax, which is also one of the ways government raise money to meet their various expenses. Now, the sixth one we'll be looking at is purchase tax. Purchase tax. Now, this is a tax imposed on certain consumers' items, such as cars, cigarettes, alcohol, electronics, cosmetics. Now, this purchase tax is usually collected at the wholesale stage. So the wholesaler, on behalf of the consumer, helps to pay this tax and then transfer the burden of this tax to the final consumers. So for those that are, but if you buy cars, you are buying cigarettes, indirectly you are paying this purchase tax. So purchase tax is based on the value of the commodity in question. Luxury goods attract higher rate of purchase tax than essential items. So for those rich that buy luxury goods, they pay more of this purchase tax compared to the middle class or the poor that buy less of these luxury goods and more of essential products. So this is an example of this purchase tax in a receipt in Indian. So as I've said, it is common in a lot of countries. It's one of the ways government use to raise fund. So that is all for indirect tax. Now quickly, let's look at the classifications of indirect tax or the system of indirect tax. Now there are two ways government can collect or system in place for government to collect this tax. The first is called the ad valorem tax, and the second is called the specific tax. So these are the two systems on ground. All these tax I've mentioned from the beginning, from your import duties to your export duties to your excise duties to value added tax to sales tax and to your purchase tax, are classified under these two, ad valorem tax and specific tax. So what is ad valorem tax? It is a tax imposed on commodities in accordance with their respective values and at specified percentage. Look at that. Look at the word I darkened there. Respective value and at specified percentage. So ad valorem tax operates in percentage on the value of the commodity you are buying. So if you are importing a car worth of, for example, 1,000 naira or $1,000, the government might ask you to pay an ad valorem tax on that commodity of 10%, meaning tax rate 10%. So that shows that you are paying $100 as tax on that imported car. So ad valorem tax is always in percentage on the value of that commodity. And examples of your ad valorem tax is your value added tax, your sales tax, your property tax, and a lot of them. So all these are classified under ad valorem tax. So far, the tax rate is in percentage. So a good example, this is another diagram that shows a fair market value of a house, and the ad valorem tax on the value of this house is 5%. It's 5%. So it's a form of property tax, but this property tax is ad valorem tax. Is ad valorem tax. So you can say as well. That's value added receipt summary. Value added receipt summary. So the second types of classification or system of tax is what we call the specific tax or the per unit tax. The specific tax or the per unit tax. It is a fixed tax imposed or charged per unit of a commodity, irrespective of the value. So this specific tax does not care about the value of the product, but it charges per unit, a flat rate, a fixed rate per unit on the product. So a fixed rate of 10 naira can be imposed on every ton of cement produced within a country or imported. Your specific tax on imported goods are flat rate tax. So they are not in percentage, unlike ad valorem tax. Your specific tax are charged per unit of a commodity, and they are not concerned about the value of the product in question, but it's fixed. The price or the tax rate is fixed. It is fixed. So quickly, let me introduce this diagram. It will really help you to understand the implication of tax on both the consumers and the producers. So the first diagram we'll be looking at is the effect of this tax if the commodity in question is elastic. If the commodity in question is elastic. Now take note, how do you know a product that is elastic? Now from this diagram, you will see that the gap between your P2 and P1, that's the price section now, P2 and P1 is smaller when compared to the gap between Q2 and Q1. And that is why your demand curve slant. That's your D. Your demand curve slant downwards. So it shows that the commodity in question or this demand is elastic. Another way to know is the coefficient. If the coefficient, the price elasticity of demand is greater than 1, the commodity in question is elastic. Now, so the first equilibrium point is where your P1, meaning your price, meets Q1. P1 meets Q1. That's the first equilibrium point. Meaning the first equilibrium point is your S1 and your D. That's where they meet. Your S1, that's your supply, and your D. But tax was introduced. And once tax is introduced, it affects the price of such commodities, number one. And then the cost of production will be very high, which indirectly will reduce the supply of that commodity. And that's why you see your supply curve shifting to the left. Your supply curve is shifting to the left. So it's shifting from S1 to S1 plus tax. S1 to X1 plus tax. So we have a new equilibrium point. And the new equilibrium point is P2 down to Q2. P2 down to Q2. So now looking at this diagram, it shows that the price before was at Q1. Now it's at Q2. Now, if you look at the gap, the space between S1 and S1 plus star, the space between S1 and S1 plus star, that is the tax imposed on the commodity in question. That's the gap. So it might be in percentage. So let's assume it is about 10%. So it shows that the transferring of that tax in form of price should also increase by 10%. But in this case, if you look at the new equilibrium point from that's in the price section from P1 to P2, you can see that the gap there is small compared to the gap between S1 and S1 plus X plus tax. The gap between P1 and P2 compared to the gap between S1 and S1 plus tax is small. So, meaning though the price of the tax increased from P1 to P2, which has to be paid by the consumer, but the supplier also have to carry a large portion of the brunt, and that is what we can see. If you are to trace the new equilibrium point down to meet the first supply curve, which is S1, you see where they meet at P3Q2. P3Q2. Now, the colors indicate who is paying what. The colors there indicate who is paying what. So, the first one, P1, P2, shows the burden that the consumer is paying, while P3 to P1 shows the burden that the supplier is also carrying. So you see that the supplier is carrying more burden than the consumer. Why? Because the commodity in question is elastic. Now, if a commodity is elastic, then it shows that the commodity in question has close substitute. So the consumer can easily leave that product and go for another one if the price is too high. So, because of the nature of this commodity in question, the producer will have to carry, or the supplier will have to carry more of the burden and transfer less of the burden to the consumer in form of high price. Of course, there are other things I will not be able to mention in this video, which is talking about debt weight loss. Debt weight loss. So I might be doing another video for that, debt weight loss. But take note of this, that if the commodity in question is elastic, then the supplier will have to carry more of the burden and the producer will have to carry less of the burden. Now, the second diagram you see is inelastic. How do I know it's inelastic? Look at the demand curve. So look at the price. Price P1 and P2, the gap between that is larger or bigger than the gap between Q2 and Q1. So an increase in price from P1 to P2 lead to a little or no change in quantity demanded. So meaning as price is increasing, quantity demanded is responding little or not at all. So in this case, the commodity in question is inelastic. Now, if the commodity in question is inelastic, going by the explanation from the first diagram, you see that if government impose tax, then we'll be having the equilibrium point shifting from P1 and Q1 to P2 and Q2. So equilibrium point, the first equilibrium point was P1 and Q1, but with the imposition of tax, the new equilibrium point is P2 and Q2. So if the same explanation, if that happens, because the nature of the commodity in question is inelastic, the supplier can transfer a larger portion of the burden on the consumer in form of high price, because the commodity in question have little or no substitute at all. So the consumer have no choice but to buy the commodity even when the price is high. Of course, the producer or the supplier will still carry a small part of the burden, but the larger part of this burden will be carried by the consumer. So you can learn more. I'll try to do a video on this again, so that you'll be able to learn more about the differences between these taxes and bringing in the specific tax and the ad valorem tax, so that you should be able to explain using diagrams. So for now, we've come to the end of this class. So take note that this class was sponsored by the Studying Addict Network Group, which is a group that allows learners and facilitators from around the world to meet and share ideas. So you can also come on board. We welcome you, and more videos will be done on this platform. Thank you.